solved problems, all about single entry and ascertainment of profit in single entry. Single entry system. Single entry bookkeeping. The term single entry is applied to a style of bookkeeping under which only the personal accounts of the debtors and creditors of the trader are kept. The usual subsidiary books are sometimes kept in just the same way as in double entry, but the postings are made therefrom of such entries as related to personal accounts. Thus, the entries from the cash book are posted only so far as they relate to monies received from debtors and the payments made to creditors. Cash receipts and cash payments are as usual entered in the cash book. From the day and invoice books, the sales and purchases are charged and credited to respective personal accounts, but the periodical totals of these books are not posted anywhere. From the bill books also, only the personal aspect of each transaction is posted to the ledger. Single entry is not any particular system of bookkeeping, but rather the double entry system in an incomplete and disjoined form. Disadvantages of single entry. 1. Single entry ignores the twofold effect of each transaction and hence presents a partial and an incomplete record. 2. The trial balance cannot be prepared and in consequence the arithmetical accuracy of the books cannot be tested. 3. Owing to the absence of nominal accounts, no classified or detailed information respecting the various gains or losses is available, and a profit and loss account cannot be prepared. 4. Owing to the absence of real or property accounts, no information is furnished by the ledger regarding the various assets of the business, and a balance sheet cannot be prepared so as to show the true financial condition of the business. 5. No detailed information is available for comparative purposes as in the case of double entry. 6. In the absence of the various checks as usually obtained in double entry system, fraud is more easily committed and is very difficult to detect. Preparation of statement of affairs from single entry books. In order to ascertain the financial position of a trader from books kept under single entry, a statement of affairs must be compiled from such information as may be available, setting forth the various assets and liabilities on a given date. For this purpose, the cash book will have to be balanced and the balance of cash in hand verified. The bank balance must be reconciled with the passbook. The list of debtors will be made out from the ledger accounts. Stock in trade will have to be taken and valued. The values of plant, machinery, furniture, fixtures and such other assets will have to be ascertained from such source of information as may be available or estimated. The list of creditors will be made out from the ledger accounts. All outstanding liabilities for expenses relating to the period will have to be included. The assets and liabilities having been thus determined will be arranged in the form of balance sheet, and the excess of assets over liabilities will be termed capital. When a statement of assets and liabilities is thus prepared partly from a trader's books and partly from any memorandum that he may possess or from his memory, there is every possibility of errors creeping in and remaining unnoticed. There are also chances of some important assets or liabilities being omitted to be included in the statement or being incorrectly valued. It is evident, therefore, that whereas a balance sheet being compiled from a set of double entry books shows the true financial condition of a business and is reliable in as much as its arithmetical accuracy can be proved by a statement of affairs being constructed partly from a set of imperfect books and partly from other source of information is absolutely unreliable. As a profit and loss account cannot be prepared from single entry books, the net gain or net loss of the trader cannot be definitely determined in the usual way. However, a clumsy and unsatisfactory method of arriving at the trading profits of any given period by a comparison of the present financial position of the trader with the one at the commencement of the period. For this purpose, Two statement of affairs will have to be compiled, one at the commencement of the period and the other at the close of the period. The former will give the capital at the commencement and the latter the capital at the close of the trading period. The capital in each case being represented by the excess of assets over liabilities. If the capital at the close is greater than the initial capital, the excess will be assumed to be profit. If the capital at the close is less than the initial capital, the deficiency will be assumed to be loss. Allowance must be made, of course, for additions to capital or withdrawals therefrom during the period. If there have been any drawings during the period, the same must be added to the closing capital, for the reason that the assets of the concern would have been more to that extent if such withdrawals had not taken place. If additions have been made to capital during the period, the same must be deducted from the capital at the close, for the reason that the assets of the concern would have been less by that amount had it not been for such additions. This is no doubt a very crude process of arriving at the trading results of a business and is quite unreliable. Problem. P. Atmaraman prepared a statement of affairs on 1st January and found his position to be as follows. Statement of affairs as at 1st January 1925. On the asset side, cash in hand 150, cash at bank 3500, due by customers 12,300, goods on hand 10,500, office furniture 750, total assets 27,200. On the liabilities, due to creditors 15,000, capital being excess of assets or liabilities at this date, this is balancing figure, is 12,200, total liabilities 27,200. Now during the year he carried on business and kept his books by single entry. At 31st December he finds that during the year he has drawn out cash from his business amounting to 3,600 and has at various times financed the business by putting cash into it amounting to 5,000 rupees. On 31st December he takes stock and makes up lists of his debtors and creditors, etc., and finds his position to be as follows. Statement of affairs as at 31st December. On the asset side, cash on hand 300, cash at bank 2,700, bills receivable 1,500, due by customers 14,450, goods on hand 12,700, office furniture 650, total assets 35,300. On the liabilities side, bills payable 2,400, due to creditors 13,500, capital being excess of assets or liabilities at this stage is 16,400, total liabilities 35,300. From the above particulars, please prepare the statement of profit made by P. Atmaraman. Solution. From these particulars, the profit made during the year will be ascertained as follows. Capital as per statement of affairs at 31st December is 16,400. Added drawings during the year 3,600. Total 20,000. Less additions to capital during the year 5,000. Actual capital left in the business is 15,000. So less capital on 1st January 1925 is 12,200. Then the net profit made during the year is 15,000 minus 12,200, 2,800. This is how we ascertain the profit in single entry bookkeeping. In the next lecture, we will discuss about single entry and conversion of single entry into double entry.